How did it come to this? How does the American dream, this idea of endless prosperity, a chicken in every pot, a car in every garage, just completely collapse into breadlines and despair? Well, it did not start with a crash. It started with a promise sold to the American people by a man the newspapers called Sunshine Charlie. His name was Charles E. Mitchell, the head of the country's largest bank, and he was one of the most admired men in America. He believed that everyone deserved a shot at being rich, and he helped build a machine to make it happen. This is the story of that machine, how it was built, how it broke the world, and how, after we outlawed it, we spent the next 70 years quietly rebuilding it, piece by piece, until we put it in everyone's pocket. In the Roaring '20s, America was a nation high on confidence. The war was over, industry was booming, and for the first time, it felt like real prosperity was within reach for the common person. And one of the leading figures of this new world was Charles Mitchell. As the head of National City Bank, the institution that would one day become Citibank, he wasn't just a banker, he was a salesman. Before Mitchell, banking was a pretty stuffy, conservative business. Investing was for the wealthy. But Mitchell saw a new market. The millions of ordinary Americans with a little bit of savings and a whole lot of ambition. His idea was simple, and for the time, revolutionary. He would create a financial supermarket. Here's how the machine worked. On one side, you had National City Bank, a trusted institution where thousands of Americans kept their life savings. It was safe, reliable, commercial banking. On the other side, you had its securities affiliate, the National City Company. This was the investment arm, selling stocks and bonds, speculative products, to the public. Mitchell fused them together. He took the trust people had in their boring old savings bank and used it to sell them risky securities. His company had thousands of salesmen all across the country, turning teachers, farmers, and mechanics into investors. They weren't just selling stocks. They were selling a piece of the American dream. And to make that dream even more accessible, they offered it on credit. This is what's known as buying on margin, and it was the accelerant that supercharged the machine. An ordinary person didn't need thousands of dollars to buy stock. They only needed to put down a small percentage of the price. The rest was a loan from the broker. At the peak of the speculation, that could be as low as 10%. It seemed like magic. If a $100 stock went up to $110, an investor who paid in full made a 10% return. But the investor who bought on margin, who only put down $10 of their own money, just doubled their investment, a 100% return. It was frictionless, intoxicating, and wildly profitable for the banks making the loans. Between the mid to late 1920s, loans for stock purchases exploded, with some estimates showing a 3- or 4-fold increase. The market wasn't just rising, it was levitating on a cloud of borrowed money, and Sunshine Charlie was its biggest champion. But behind the facade of prosperity lurked the mathematics of catastrophe. Some people saw the danger. By early 1929, the Federal Reserve had grown deeply concerned. It saw that the rampant speculation wasn't just a bubble, it was a threat to the entire financial system. So the Fed decided to act. Throughout early 1929, it sent warnings to the banks, urging them to tighten credit and restrain the flow of money into the speculative loan market. The market shuddered. Panic started to set in as interest rates on those margin loans soared. It seemed the party was finally over. And then, Charles Mitchell made his fateful move. He publicly defied the Federal Reserve. In a statement that made front-page news, Mitchell announced that his bank, National City, felt it had an obligation to prevent a crisis. He declared he would make credit available to the market. The effect was immediate. The panic subsided. Newspapers hailed Sunshine Charlie as the savior of the market. And while it wasn't a straight line up, the Dow Jones Industrial Average, after a shaky spring, did roar back to life, eventually soaring to its all-time peak that September. Mitchell hadn't just ignored the Federal Reserve. He had stared it down and won. He kept the machine running, feeding it with more credit, pushing it faster and faster. He had reassured the public that there was nothing to worry about. But in doing so, he helped ensure that when the crash finally came, the system would be far more brittle, far more leveraged, and far more devastating than anyone could imagine. The system was now stretched to its absolute limit. The end came in October 1929. Smart money had already started to quietly exit the market. They saw the signs. Industrial production was faltering, and the endless rise in stock prices had become completely detached from corporate reality. On October 24th, Black Thursday, the selling began. But the real collapse came the following week. On Black Monday, October 28th, the Dow fell nearly 13%. The machine went into reverse. The magic of margin lending became a death spiral. As prices fell, brokers issued margin calls, demanding investors put up more cash to cover their loans. But the cash wasn't there. People had invested everything they had. They were forced to sell their stocks at any price, just to cover their debts. This wave of forced selling pushed prices down further, triggering even more margin calls. It was a cascade of liquidations, a feedback loop of pure panic. On Black Tuesday, October 29th, the market collapsed completely. The ticker tapes ran hours behind, unable to keep up with the sheer volume of selling. Fortunes built over a decade vanished in a day. The popular image of investors jumping from windows is largely a myth, but the financial ruin was terrifyingly real. The savings of millions of Americans, so confidently placed in the market, were simply gone. In the aftermath, a stunned and angry nation demanded answers. The Senate launched the Pecora Commission, an investigation that would expose the inner workings of Wall Street to a horrified public. And Charles Mitchell, one of the first major Wall Street banking heads to be called, was its star witness. The hearings revealed how National City had aggressively pushed its own bank stock onto employees and customers, how it packaged and sold risky foreign bonds that later defaulted, and how its officers had received millions in bonuses while the country slid into ruin. Mitchell himself admitted to selling a huge block of stock to his wife to create a tax loss. The man once celebrated as a financial genius was now seen as a symbol of greed and recklessness. Senator Carter Glass would later be widely cited as saying Mitchell, more than any 50 men, is responsible for this stock crash. The Pecora Commission's revelations created an unstoppable political will for reform. The problem, Congress decided, wasn't just a few bad actors. It was the machine itself. The very structure of the financial supermarket, which fused safe commercial banking with risky investment banking, was a fundamental conflict of interest. So they passed a law, a legal wall. In 1933, Congress passed the Banking Act, now famously known as the Glass-Steagall Act. Its purpose was simple and direct: to separate commercial banking from investment banking. Banks that took deposits from ordinary people could no longer use that foundation to underwrite, sell, or speculate on securities. They had to choose. You could be a utility, or you could be a casino. You could no longer be both. Glass-Steagall was a structural answer, not just a punishment. It also created the FDIC to ensure bank deposits, restoring faith in the system. And for more than 60 years, that wall stood. It created an era of relative stability, not without its own crises, like the savings and loan meltdown, but it did prevent a repeat of the 1929 catastrophe. The machine, it seemed, had been permanently dismantled. But memories fade. A new generation of bankers began to see Glass-Steagall not as a safeguard, but as a restraint, an outdated barrier to innovation and, profits. Throughout the 1980s and the 1990s, regulators and banks chipped away at the wall, granting more and more exceptions. The final blow came in 1999, with the signing of the Gramm-Leach-Bliley Act. The core provisions of Glass-Steagall were repealed. The wall came down. President Bill Clinton declared the old law was no longer appropriate. Once again, commercial banks, investment banks, and insurance companies were allowed to merge. The financial supermarket was back in business. Supporters argued it would make American firms more competitive. Critics warned it would reintroduce the very conflicts of interest that led to the Great Depression. The 2008 financial crisis, driven by banks selling complex, risky securities built on a foundation of subprime mortgages, would lead many to believe those warnings were prophetic. The machine had been rebuilt, bigger and more complex than ever before. But the story doesn't end in 2008, because the structure rhymes. Today, the machine has been miniaturized. It lives in your pocket. Zero-commission trading apps have made speculation frictionless and accessible to millions. Complicated financial instruments like options and leveraged tokens are marketed with game-like interfaces. Cryptocurrencies, promoted as the democratization of finance, can see their value multiply or evaporate based on a single tweet. Now, to be fair, today's platforms have a lot more rules and disclosures than anything that existed in the 1920s. But the incentive structure can feel eerily similar. Once again, ordinary people are being recruited into speculation through platforms that profit from volume and activity, regardless of whether the user wins or loses. Once again, leverage allows small price movements to become catastrophic. And once again, the promise is the same one Sunshine Charlie made a century ago, that this time, everyone can get rich. The interface changes, but the core idea, a machine that turns citizens into speculators by offering easy, leveraged access to financial markets, was never truly destroyed. It was just upgraded. And that leaves us with the same question our grandparents faced in the wreckage of 1929. When we give everyone a ticket to the casino, who is responsible when the house of cards collapses?